Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Day to day, our focus tends to be on the future of individual businesses and the environments in which they might succeed, perish or plod. But like a guard protecting a castle from its parapet, we do have to occasionally scan the distant horizon for longer term threats. Since the GFC, the growth that we wanted could not be justified by the productivity we produced, and so unconventional monetary policy settings have instead inflated bubbles in the vain hope that the implied prosperity would incite consumption. There was some success, but the policies also widened the inequality gap, enriching those who already had assets and leaving behind those who did not. Sadly, the other outcome has been the emergence of dependence on a debt-filled intravenous drip of low interest rates and a tangible fear of the consequences of going cold turkey. We now live in a world where asset bubbles are no longer glitches, but a semi-permanent feature of corporate and financial life, and a world where investors are not only unable to endure normal corrections or volatility, but our politicians and central bankers even less. I like the way one analyst put it recently. The objective of the modern monetary policy is to engineer controlled defaults at a pace slower than the rise in asset prices and accumulation of new debt. This requires ever lower volatilities and constant asset price levitation. Now, the continuation of such a policy must ultimately lead to the squeezing out of the private sector in bond markets, and if the policy is extended to equity markets, central banks must eventually be the largest owner of equities too. Taken to its full term, the nationalisation of credit markets means the destruction of the price signals investors use to make rational decisions. Of course, taken to full term, nobody needs those price signals anyway. But if the end game is disturbing, more disturbing might be the road to that destination. Outcomes could include a classic reflationary boom and a steepening yield curve, a negative risk for equities and particularly the most expensive tech and growth stocks. You see, central banks will have to be more aggressive in their use of unconventional monetary levers to keep volatility at bay. And I note reports that the Fed is set to inject another $1 trillion into the system and that US $236 billion Treasury General Account drawdowns have already occurred. The most recent sign that this disturbing journey has begun is the US Fed's recent decision to abort its traditional inflation target. And if all this is happening at the same time that a post-COVID world is gradually getting back on its feet, we could have all the monetary and fiscal drivers of reflation and yield curve steepening that we need. Investors, particularly that happy band of first-timers addicted to high momentum growth stocks, may yet discover the dangers of avoiding value investing and even cyclical businesses. That's all for me today. I look forward to talking to you again soon, and in the meantime, please continue to follow us on Facebook and Twitter.